Hey, welcome everybody to the First Down Financial webinar, our Safe Growth Retirement Seminar. My name is Steve Vetterl, one of the managing partners, along with my partner in crime, Stephen Ruff, behind me. We run First down here in Orlando. I'd like to welcome everybody to the webinar. So this is an inaugural event for us, and we appreciate Samantha's efforts at the USDA and helping us get this off the ground. We're going to be running these webinars for every month throughout the next couple of quarters. Sometimes we'll be on site. Sometimes Steve and I will be on camera from the headquarters here in Orlando. Either way, we will be recording all of these events to go through and talk about everything that has to do with current retirement planning. So we've laid out a structure that we're going to be used going forward to successfully get everybody educated in the fields of retirement planning, and most importantly, at least our concern with the current marketplace and everything that we're doing to position clients to avoid big downside risk. And it's of paramount importance right now because as you may see going forward with some of First Down's blogs and some of the different writings, we're concerned of the current level of the market. So let me go ahead and share a screen here. We'll go through just a couple of PowerPoint slides, and I'll have my partner Steve talk as well. So this is just an introductory. So we're sort of, we've had a lot of, let's just say, interest from different federal government, agencies, primarily USDA and a couple others we're working with. And so we're pretty honored to get in the door. I know that you guys have a fair amount of education that is brought to you from inside the federal government, but we're going to give you an outside, unbiased view of kind of what's going on. And I would always encourage you to take this from a perspective of avoiding risk and sort of understanding, we can certainly help you allocate the portfolio and get diversified, but avoiding big risk in the marketplace is one of the things that we've been awarded for. So I always think it's important, as I tell clients and a lot of prospective students and so forth, some of our outside advisors, we are a nationwide investment advisor. So we're licensed in all states. We offer every product in existence. We specialize in a lot of tax advantage strategies, also retirement income planning. The firm is a RIA licensed with FINRA and the Department of Financial in Florida. We are also a DFA Catalyst approved advisor. I could talk about that a little further down the road. And we custody directly with Charles Schwab. So my partner, Steve Ruff's been in the insurance industry. You can see here for a long period of time. He is a thought leader in this industry. He brings a deep bench of expertise in multiple investment strategies, including tax-free growth and income. So he's a retirement estate planning expert. Steve's done really well, and he's received multiple top-tier industry awards as a top 1% advisor in the industry. Both Steve and I work with each other. And we have our families in Oviedo, Florida. My bio here, been in the industry a long time. I wear a number of different hats. I have throughout the last 20 plus years as running different organizations. But primarily, I think I probably recognize most in terms of portfolio acumen and trading. I've been taught by some of the best in the industry, won a bunch of awards, have a degree in finance from Xavier. And, even though this really isn't about the Steve and Steve show, I think it's important for everybody looking at us because there's just so much different and all kinds of ambiguous information out in the industry. It's important to kind of know who you're dealing with. So I always like to show kind of a bio, even though we really want to make this about the client. I think it's important that if you want to view our website, you can click on media and awards and see everything we've done, blogs, we talk, different broadcasts, my weekly podcast. I've actually written money for a number of different websites that's been recently published and so forth. So you can take a look at the website, but let's go ahead and get into the presentation. And the agenda today essentially is ways to indemnify your TSP, right? Investment accounts, IRAs, using essentially a thought out and prudent path to make sure that you and your loved ones never run out of money for the rest of your lives. So essentially what Steve's going to talk about is mitigating your portfolio against market risk while still achieving diversification. And believe it or not, it can be done with a very low cost and very protective based approach. So turn the mic around to my esteemed partner, Steve.
Hey, hope everyone's having a great day here, and I appreciate you joining the webinar here. So what we're going to do, when I founded First Down Financial, we wanted to basically have a firm that not only was worried about managing assets or doing selling insurance products, but basically a firm that can mix taxes into that. How do you save taxes? How can we avoid Social Security being taxed because you're making too much money at retirement? There's a lot of planning, and most of the managers out there, all they want is as much as they can get in management, and they charge a fee, and that's really all they'll do. You'll just pay them an annual fee or a quarterly fee, but they don't get into the nuts and bolts of your retirement. And what we do is we treat everybody as an individual. So to me, on there, you might be the same age, same dollars as somebody else, but your needs are completely different because you might have no debt. Somebody else is, 80% debt. You might have, 5 kids and 12 grandkids. The other ones might have no kids and no grandkids. But management usually is all we care about is age, income, and then you're going to be traded in a block trade with other trades. So you can't really get that individualized treatment by that broker. So that's what you're going to find is different with First Down Financial. Everybody is different. We go plan by plan, and that's how we basically go ahead and do that on an individual basis. So if we want to go ahead through the first slide on there, or the next slide on there.
So you want to start with
let's go right into the SILAC brochure.
Okay, let's talk about that.
Okay, this is one of mainly about 300 companies we represent. You'll be familiar with all these different companies, the stock companies and the symbols. What I like about this particular product, when you're getting ready to retire or at 59 and a half above, TSP allows you to roll your money out if you want. Because right now we're in kind of a crazy market. We don't know whether it's going to go up or recession or inflation carry on. But what I like about this product, you're in a lot of the companies you're probably in now. And what happens is they divide the S&P up into 11 sectors. And what they do is Credit Suisse manages that money and moves it to those sectors. But what I like about this annuity is you can be invested in here and never lose. If the market crashes 50% in a recession, you get a zero return. Every single dollar still stays in your account. But when the market goes up, you get a great return. So this is a lot of my doctor clients and retirees from major corporations are in this particular annuity. And right now, S&P was down 21%. They didn't lose a single dime in 2022. So that's, I think, a great benefit of that particular annuity right here. And you're in a lot of the same places you're at right now. So having that downside protection is key because you're coming to the end of a career between 60 and 65. And what you don't want to do is have to start over, take a TSP balance from 800,000 down to 400,000. And now you've got to build that retirement and probably end up working a lot longer than you wanted to build that back up. So this is a great plan and one of many annuities that we have that'll go ahead and do that. Now, this one also I like because it offers a bonus on there. So they'll give you a transfer bonus, which is cash right into your account. Depending the state, depending on age, that bonus can range from 5% to 10% bonus. So that's a little bit about the one particular product. But again, like we talked about, how do we prevent losses from your account? And this is one excellent way right here, this particular product. If you want to go to the next one there.
Yeah, one thing I do want to note is that we've been talking actually a little bit about this when we were on site in DC last week at USDA's headquarters was and I think one of the participants in the audience brought up a good question about, how does retirement planning play out and, explain how the different sort of steps play out. And I said to him, it's important to go through the steps as we do with all clients because all clients receive phenomenal attention from us. But at the same time, the steps are important in order to be able to execute. And ideally working with an advisor, as we talked just a little bit about last week, historically with a lot of the white papers that have been released, has almost a 3% higher return to the overall relationship and the client's return. So there really is value in, as we see it, working with an advisor. So the next sheet that Steve's going to present is a proposal type of sheet that we use to explain kind of the comparison, if you will, side by side between maybe a client's current investment in orange versus a recommendation from, in this case, Silac family. So
Yeah, and this compares what I just showed a minute ago on here. Let's just say you have 400,000 in a TSP account. And you can see in red in the third year, we just assumed 120% loss. Now, I think we'd be all kidding ourselves if we think over the next 25 years, we're only going to see a 20% loss at one time in the market. But if you look at that on there, and it could be year 3, it could be year 2, it could be year 10, we don't know, but we assume one loss on here. Look what that does to your account on the left side, but look at what the income is. If you waited till RMD age at 72, it's going to be going to 73, but right now it's at 72. You can see the difference in income on 72 of 20,000 versus 43,000 on there. But if you look at the through age 85, if you want to scroll up just a little bit there, you can see your total income you've drawn through age 85 is more than double with Silac, and your ending value you're looking about is almost 3 to 4 times the size in Silac by avoiding that negativity of the market. Now, to give information on this, we figured a net 5% return in current investment. So that's about a 6.5% return, fee of about 1.5 through the average broker fee. So that's making 6.5% a year, netting 5. And you can see the difference of how Silac's perform versus the market. And that's the beauty about having a plan that does not allow downside risk. So this is an example kind of one of the options. But again, it's a huge difference by going and avoiding negativity in the market. And one other example I'll give you is in 2000, in 1999, the market was killing it. A lot of you were probably at USDA and back in that time as well, 22 years ago. But if you had $100,000 in 1999, okay, it took you to 2013 to get back to your 100,000. It was basically, they call it a lost decade, but it was really longer than a decade because your money lost in 2000 through 02. You started creeping back through 07. Then we hit the 08 crash, went back down, took you to 2013 just to get your money back 13 years. Where these annuities, you would have been double on that because we would have avoided the 4 major losses, which were 2000, 01, 02, and 08, with 0 returns, 0 losses. So we would have been way ahead of the game on that in your particular TSP account. So we are big believers in from 60 to 65 being safe, but also having great returns. And you probably do that in your TSP plan now, mixing between the G and the C fund. Okay, you're going on the C, I want to be safe. Returns are 2, 2.5, 3%. I'll go equities in the other one in the G. But just think of that. If the G fund returns 10 and the C is returning 3, and you do a 50-50 distribution, what did you make? You made 3% on, let's say, 50 grand. If you have 100,000, that's 1,500. 10% on the other 50 is 5 grand. So you had about a 6.5% return by mixing those two. But if equities lose, okay, and lose 20%, you lost 10,000. You only made, let's say, the safe and the C fund made 1,500. You lost $3,500 that year, or you've lost about 3.5% in that year. So how do you avoid the losses is what's key when you reach a certain age, getting close to retirement. All right, if you want to add to that, Steve?
Yeah, and if you would please, because I think this will certainly benefit our audience. Speak maybe just briefly, if you would, because your explanation of this is really good. The difference between banks and insurance companies in terms of just risks, since our focus is kind of on risk.
Okay,
So
we went over that at the headquarters in Washington. banks work on a 1-to-9 ratio. So if you look during the Depression, or if you look in the recession of '08, okay, in '08, for example, 9,700 banks went under. Why did they go under? Because they work on a 1-to-9 ratio, which means for every dollar deposited, they can borrow from the federal government $9 for every dollar. And what they have to do is collateralize that. When we hit the land crisis in '09, as far as '08, I'm sorry, then the collateralization was not up to par. The government would ask the banks to put up cash to secure that 1-to-9 ratio. The banks that couldn't do that, they closed down. Insurance companies work on a very boring 1-to-1 ratio. So for every dollar in liability, they must reserve a dollar. Dollar for dollar is the safest system. And that's why, people during the Depression in '29 through '32, Babe Ruth, for example, he was getting paid through annuities on there because he was in insurance products versus the banks. And those banks at that time went under, a lot of them, and caused, to me, great panic. And, is my money going to be there? Well, a lot of the money wasn't there. So that's again why we like insurance products again versus banks, because of the 1-to-1 ratio. So that's where your safety is with an insurance product.
Yeah, so I mean, just wrapping everything back in, I know we've had attendees kind of join in at and some that have had to run to meetings and so forth. So we're cognizant of that. But we've recorded this, you guys, and we're going to record them all. And I would imagine as 2 different webinar ideas have been brought to us. Well, I'm going to do one from a very generic standpoint that kind of sort of dovetails in with the one that the first program presents to you guys, and then so forth. But at the end of the day, really what it is the diversification is not a difficult thing to attain for clients. We can certainly help you with that, but understanding how much, as we had shown on the piece here, and I'm going to share the screen again, just jumping around to different screens, but with this piece we spent a lot of time on with clients because it really does break everything down. And just to reiterate what Steve said, is seems like a lot of numbers on the screen, but a client starts off with a $400,000 investment. In this particular example, there happens to be a 10% bonus on it, which is great. That helps the retiree right off the bat with a bonus, even if there is no market returns in a given year. But it also assumes a decline, which we've already seen. I think that we've been quite generous in this presentation because there's multiple declines through different years. It could certainly happen in any time in year 15 on. It has really shown to happen a lot more frequently. And the most detrimental thing is if you're in a product that is not in a protection based, not loss, or have no potential to lose, you're drawing income out of your portfolio and your accounts are going down. That's when there's real risk to the longevity of the account playing out over any period of time. Plays into the mix. So, but we wanted to kind of keep this short. I'm actually in the office all day. I've already gotten 2 requests for calls. So if you guys want to give us a call, let me just jump back to the spreadsheet. We can help you out with everything.
One thing I just want to add real quick. One of the analogies I use, and I've used it at the meeting in Washington, but I've been using for a long time on there, is that you've got Social Security, you've got a pension with the government, you've built up this TSP account. You've already won the race. Like a marathon runner, once they finish that marathon, they're done running. You, on the other hand, have already won the race. You don't need to strive after double-digit returns. You now shift more to safety because you're in a great position. Okay, if you try to go for those returns, you might get lucky, you might make them, but you might also destroy what you've built and then have to rebuild that again. But here what Steve put up, that's a great chart that shows risk and reward. The left side has great potential from going left to right. You'll see the returns go down, but the risk goes down. But on the right side of the pendulum there, what you're going to find is no risk in those, and indexed annuities is going to give you on the far right. The dark green is going to give you your biggest potential gain with 0 on the downside. So that's again why, from retirees' point of view, I don't think anything beats the indexed annuity side. Now, it did come up fees. We don't charge fees for on the annuity side. The companies pay us. So when you go to money management, there's going to be a fee. When you go to an annuity purchase, there is no fee. We get paid directly from the carrier. So that's again why I like that, because 100% of your money goes working for you and no fees are coming out of that. So again, that's on there, kind of this pendulum shows what the options are out there.
Yeah, the other concern, I'm gonna let Steve talk about this one as well, because I'll oftentimes get people that will ask me, well, yes, my accounts went down, but the market always comes back. And although that may be true, the problem is how long is that duration before the market comes back, right? I mean, Steve talked about 13 years in the previous 1999 example. There are multiple examples in the last 4 decades where it's taken 10 plus years for the market to come back to flat. And this illustrates that.
Yeah, it's if you look at the bottom number, and the only reason I go the 50, that's what was lost in 2000 through 02. It was 51%. You need 100% return. So if you have $500,000 that shrunk 50% down to 250, you now need 100% return in the market to gain your money back. So returning 50% after losing 50, you're only at 75% of your original value. And you can see every different increment on there. Like if, for example, if it's 30%, you got to make 42 or 42% to make back a 30% loss. So this is why it's not as easy as it seems to go ahead and do that. And especially if you're with a money manager, when you're done with TSP and you're having fees on an annual basis as well, that comes out of that too. You got to make that back as well. So again, and the last thing I'll go, there's always words out there on annuities. They're bad, they're no good. There's bad annuities, there's very good annuities on there. Just like there's bad mutual funds, there's good mutual funds, there's good stocks, bad stocks on there. Your indexed annuity is your lowest cost annuity, protects the downside. In most cases, zero fees. There are a couple small fees if you want riders, but with no riders, there's zero fees, and they have great returns because they're index based. So those are the best annuities out there. But when you speak to people and they hear annuities, they handle the old New York Lifes or the old companies, they charge fees, they're low returns, expensive. Those are not the indexed annuities that First Down Financial utilizes. We utilize annuities that have great growth, downside protection, zero fees, and even offer bonuses on top. So that's what we like to tell you on this, that there's a lot of products out there to use, and we're going to make sure we have an optimal product for your situation.
Yes, I mean, that's pretty much the presentation. And we don't want to get too into a lot of these concepts. I mean, really, if you're looking at the screen right now, there is literally risk to almost every one of these categories right now, and a much more sustained risk. And I would even argue these arrows should be even lower, quite frankly. But with the exception of some of the more safer areas, we can certainly guide you guys to a better retirement. It's what we've won awards for. It's what we're known for. So I would encourage everybody, if you didn't get the chance to see the whole broadcast, let your heart not be troubled, as my mom always says. We'll have the recording available, and we'll send that out to everybody. And then feel free to either ask us questions via the chat, which is now open, or you can email me questions, and here's the contact sheet for the firm. So you can send me an email. It's just steve@firstdownfinancialinc.com, or you can give us a call, or you could send something to us in the chat room as well. But want to thank everybody for attending today. Steve and I are real appreciative of the opportunity that's been given. We will be seeing a lot of you soon, more on campus. We would encourage you, if you have any questions, feel free to please reach out. Have a great day.
Thank you very much.